If you are a trucking business owner, one of the best things you can do to minimize the amount that you have to pay out in taxes each and every year is telling the IRS how you want your trucking business to be taxed. You heard that right. You can have a sit down with your accountant, you can run the numbers, and you can determine for yourself and for your business what tax classification works best for you, and the IRS is going to say, no problem, we'll go with it. So in this video, I'm going to break down 4 of the major tax classifications: sole proprietorships, general partnerships, S corporations, and C corporations. Which one is best for your business, some pros and cons, and which one is best for your trucking company at the different stages of growth. So small trucking companies that are just starting out, owner operators, lease operators, all the way up to large trucking companies and fleets. What is the best way to structure your business for tax efficiency in terms of the tax classification? If you guys are new here, my name is Fahad. I'm a tax accountant, IRS licensed enrolled agent, and QuickBooks Pro advisor. I run a virtual tax and accounting firm servicing all 50 states. We just work with trucking companies, company drivers, owner operators, fleet owners, anybody and everybody in the trucking space. We help you guys optimize your taxes, keep more of your hard-earned money in your pockets at the end of each and every year. Now, enough of my intro, let's get into the video. So before we get started, the prerequisite for this, the thing you need to have in place before you can change tax classification, is that you need to have some kind of legal entity in place. If you don't have a legal entity in place, you're not going to be able to change the tax classification. You must have an entity in place. Now, for most people, for most businesses, I'm going to recommend that you go with a limited liability company, because limited liability companies can run the gamut. All 4 of these tax classification options that we're going to speak about, all 4 of them are something that LLCs can take advantage of. However, if you are a corporation, if you've registered the corporation with the state and you're doing business as a corp, you're only going to be able to take advantage of 2 of these tax classifications. So let's get into the classification options. The first one is what's called a sole proprietor. So if you're doing business by yourself, or you run an LLC, you open an LLC that is a sole member, it's just you, nobody else, you are going to be taxed as a sole proprietor. What this is a pass-through type of taxation, meaning the IRS treats your LLC just like a sole proprietor. You are taxed at the personal level. You do not have separate business taxes. You don't have a separate business tax return. Everything is done on your same tax return. We add what's called a schedule or an addition called a Schedule C. And then we go through, we say, okay, this is how much income we had, this is how much expenses we had, and this is the profit that was generated from your business activity. And then that profit adds on to your personal income. So with being a sole proprietor, you do have 2 different types of taxes that you must pay. The first is federal income tax, and the second is self-employment payroll taxes, Social Security, Medicare, called FICA. So the benefit of being a sole proprietor is the ease of everything. So not only is your tax return pretty easy, many tax preparers are going to be able to get your return filed. If your situation is not too complicated, it's probably not going to be too expensive as a return, and it's very, very simple to file and kind of get set up with. So in the big beautiful bill, it provided an extension of what we call qualified business income. It's a 20% deduction on pass-through income. Now, sole proprietorships are 100% pass-through businesses. All of the business income or loss passes through to the individual who runs the company, and that is what we call pass-through status. As a pass-through, you're able to take advantage of a 20% deduction. That means, for example, if I made $100,000 in profit, in net profit at the end of the year, I get a $20,000 deduction come tax time. Amazing deduction. As a sole proprietor, you are able to take advantage of the QBI deduction in full. Now, the second tax classification I want to speak about is a partnership. So this is going to be the case if, let's say, you are either doing business with somebody else, okay, and your entity is not registered, or you have a limited liability company and you have 2 or more members. In that case, you will be treated as a partnership for tax purposes. The way it works is that the partnership itself, the entity, is going to file an informational return with the IRS. This informational return is known as a 1065. So the 1065 information return is basically going to go over things like revenue, expenses, kind of the activities of the partnership throughout the year. And then what's going to happen is that partnership is going to issue K1s, Schedule K1s, to each of the partners. Now, on those K1s is going to be each partner's allocation of income, of loss, but each partner is going to have income or loss allocated to them. The partners are then going to pay self-employment tax as well as income tax on their respective share of the partnership's income or loss. Now, the cool thing is that partnerships also are pass-through entities, which means just like sole proprietorships, you are eligible for the 20% QBI deduction on your partnership income. Once you have income, you can take a 20% deduction on it on your personal tax return when it comes to tax filing, and you can get a pretty handsome deduction. So partnerships are very similar to sole proprietorships. They just kind of have the partnership filing requirement that comes up. So now let's talk about the corporation tax classification. There are two types of corporate tax classifications in the tax code. There is C corporation and there is S corporation. So if your business is treated as a C corporation, the IRS is going to look at that like a completely separate entity. It's going to have separate revenues, it's going to have separate expenses, it's going to have separate income, and it's also going to have a separate tax return. The 1120 is the C-Corp tax return. All of the revenue, expenses, profits, dividends that get paid out to the shareholders, all that happens on the C-Corp's tax return. And then what happens is that any dividends that are left over at the end of the year, for example, let's say the C Corporation made $300,000 in revenue, you had $200,000 in expenses and $100,000 of income. Now with the sole proprietorship, that income would just pass through right to the owner. With the C corporation is first going to pay income tax on that money. So at 21% corporate income tax right now, it's $21,000 that the corporation pays in income tax. And then what's left over, the $79,000 left over, that goes to the shareholders in the form of dividends. Now, I can choose to keep some money in the company, which is called retained earnings. But if I choose to take all the money out, then I am taxed again on those dividends. So this is what's referred to as double taxation, because the corporation itself, the entity, is paying 21%. And then I, as the shareholder who is getting the dividends, I'm also paying a tax on the dividends that I received from the company. Now, C corporations are really, really well adapted to bigger companies, right? There's a reason why the Apples, Amazons, Googles, Facebooks of the world, they're all set up as C corporations because they have a lot of shareholders. C corporations are really, from a tax perspective, set up for bigger companies. So if you run a bigger company, a bigger fleet, let's say you've got, 50, 100 trucks, maybe you might want to consider being a C corporation, because C corporations are set up like that. They're set up for having a lot of different shareholders. That's why you have double taxation, so that, you can change the ownership very easily. The C corporation itself is not affected if the ownership changes, because they are two separate things. So the last one I want to talk about is one that has been very popularized. It is called S corporations. The way that S corporations work is they are essentially a hybrid between partnerships and C corporations. Reason being, C corporations tend to be too rigid many times for many smaller companies. You have double taxation, you have this very, very strict separation between the corporation and the shareholders, whereas with a partnership, all of that income or loss is going right to the individual partners. So the S corporation is kind of a mix or a hybrid of both of these. So the way it works is that the S corporation will file a separate tax return called an 1120S. Now the S-Corp is basically going to go ahead, revenue, expenses, profit, you're going to go through all of that. Now those profits are going to pass through to the owner of the company. So let's say I have $300,000 in revenue, $200,000 in expenses, and $100,000 of profit. All of that profit is going to flow through to me. With the C corporation, the profits did not flow through. The corporation had to pay tax on those profits individually, and then whatever was left over from those taxes, that could go as dividends to the shareholders. With S corporations, it's different. S corporations, any profits that are there go straight to the shareholders. Now, the benefit is those distributions you don't have to pay self-employment tax on as the shareholders, the owner of the company. However, the caveat is that the IRS does require you, because the S corporation is set up for smaller companies, is they require you as the owner to take what's called a reasonable salary. There's many different types of reasonable salaries, whether it's going off of something that's similar to what another company would pay you, like a reasonable salary off of Indeed or Monster.com. Whatever it is, you need to be paying yourself a reasonable salary, whether that's 40, 50, 60% of those profits should be coming in the form of salary. Now, the reason the IRS does do this is because if you did not have to have a reasonable salary, that would mean you would not be paying self-employment taxes anywhere, and you would completely be skirting the self-employment taxes. It would be quite an overpowered way for you to actually have a business set up. So this is the reason why the IRS requires, if you are the owner, if you are active in the business, you must be taking a reasonable salary from the S corporation. So here are some key takeaways. Sole proprietorships, simple, cost-effective, and also you do pay tax on all profits. However, you also get a QBI deduction, which is now permanent in the tax laws. You do get a 20% QBI deduction on all of your net income if you qualify for the deduction. Partnerships have very similar tax treatment to sole proprietorships, but it's just split amongst the partners. C corporations are taxed at the entity level first, and then you also pay tax when you take out dividends from the C corporation. Now, for S corporations, yes, you do pay federal income tax and Social Security and Medicare tax on the salary, on the reasonable salary part of the money you take out from the S corporation. However, you only pay federal income tax on the excess, meaning whatever's left over, the distributions, you do not pay FICA taxes on those distributions. Truckers, I hope this video was helpful in helping you break down which tax classification is best for your trucking business. If you enjoyed this video, please like, comment, and subscribe, and I hope to see you guys all next time. Please stay safe on those roads. God bless.